Most people only notice a company when it gets loud. By then, it's too late. The real money is made by the time everyone else figures it out. Applovin, ticker APP, is not loud, but it is dangerous because it's winning quietly while other platforms scream for attention. The truth. Most investors have no idea what this business actually does. They look at the stock chart, which is up almost 300%, see the run-up, and assume the upside is gone. What they miss is the system behind the results. A system built for speed, built for scale, and built to reward performance over perception. That's the gap. People keep comparing AppLovin to the wrong companies. They keep measuring it by the wrong metrics, and they're making decisions based on a business that doesn't exist anymore. So if you're still thinking of this as an ad platform or a mobile game company, you're not just behind, you're completely misaligned. And in markets, misalignment is how you lose. This isn't a hype story, it's an execution story, and most people are on the wrong side of it. If you were running ads, would you rather pay when they work or pay no matter what? Most platforms charge you either way. Win or lose, they take their cut. That's not alignment, that's a tax. AppLovin doesn't work like that. 80% of their revenue only shows up when the ad converts. No click, no install, no purchase. They get paid zero. The result is the product, not the placement. That's not ad spend anymore, that's weaponized capital. Advertisers don't just use AppLovin, they depend on it. Because app discovery, their demand-side engine, doesn't waste budget. It finds users who want to buy, and when that happens, AppLovin earns. The rest of the stack is just as lean. Max, their supply-side platform, takes a 5% fee to help publishers monetize. It's clean, scales fast, no bloat, no fluff. The feedback loop is ruthless. More conversions bring more spend trains better data. Better data delivers better outcomes, and that engine keeps tightening. This is not a platform that lives off potential, it lives off results. That's why advertisers flock to it, because when every dollar is tied to outcome, you're not just advertising anymore, you're scaling proof. AppLovin's AI black box is eating the industry alive. You don't control it, that's the point. Axon 2 is AppLovin's secret weapon. Advertisers plug in their budget, their geography, and the return they want. That's it. Everything else is handled by the machine. It doesn't ask for your opinion. It doesn't offer sliders or dashboards. It just finds the people who buy and sends the ads straight to them. No hand-holding, no guesswork. This is not a toolkit. It's a black box powered by real AI. You don't get to tweak it. You get out of its way because it doesn't need you. Advertisers aren't upset by that. They're relieved because it works. Axon 2 outperforms Meta's engine by over 45% on return. That's not a feature, that's a problem for everyone else. And every campaign makes it smarter. Every dollar sharpens the targeting. Every outcome compounds the system. This is not AI as marketing fluff. This is AI that eats your job. It doesn't automate your campaign, it replaces your strategy. Competitors can't copy this. They built software. AppLovin built a black box that trades budget for outcomes without a human in the loop. And that's why the moat keeps expanding, because Axon 2 doesn't need to scale teams, it scales results. The numbers don't lie. AppLovin is a profit machine. Most companies talk about scaling. AppLovin actually did it. Right now, they're running a 42.3% net profit margin. Their free cash flow margin, 50.5%. That's not normal, that's elite. Most ad platforms are burning cash just to survive. AppLovin is compounding it. Their return on invested capital, 64.3%. The S&P 500 averages around 10%. That's not outperformance, that's domination. Now look at efficiency. Sales per employee, $805,345. Most companies with that level of output are barely profitable. AppLovin is doing it while returning 50% plus cash margins. That means every employee isn't just productive, they're scaling capital. This is the result of a system that removes friction. Fewer people, less overhead, better outcomes. Every lever in the business is tied to performance, and that's what makes this dangerous, because they don't just grow, they grow with margin. They scale without drag, and every quarter the model gets tighter. You see, most ad tech companies are still pitching upside. AppLovin is stacking cash. That's what real execution looks like. Everyone saw the run, but almost no one understands the engine. AppLovin is up 287% in the last 12 months. Investors see momentum. What they miss is the machine underneath. This isn't about a breakout chart. It's about a business model most people still don't understand. They're calling it a gaming stock. They're wrong. Applovin is an ad tech infrastructure company, and the core is a system that gets smarter every day. The gaming studios, they're dumping them. The margins are better in ad performance, and they know it. Over 80% of revenue now comes from a demand-side platform that only charges when results happen. Not impressions, not clicks, actual conversions, measurable, third-party verified outcomes. That's not branding, that's execution, and that's where Axon 2 comes in. It isn't selling ad space, it's selling outcomes. The advertiser just plugs in a budget, a target return, a geography, and Axon does the rest, automatically with real-time feedback loops that make every campaign better than the last. So yes, the price ran, but the system behind it still mispriced because most investors don't understand how this thing compounds. They're chasing the stock. I'm watching the machine, and the deeper the engine gets, the wider the gap becomes. So is applovin a long-term buy or just a hot trade? Let's call it what it is. Most investors buying this stock have no idea what they're holding. They're chasing momentum, not understanding the moat. So here's the real question. Is the business built to last or built to flip? The bull case. Applovin is not an ad tech company. It's a machine that converts spend into revenue. It has performance-based pricing, which is aligned with advertiser incentives. Axon 2 continues compounding advantage over manual platforms like The Trade Desk, and gross and free cash flow margins are in the top percentile of the entire market. And ad budgets are shifting towards outcome-based systems, and applovin is ahead of the curve. The more it runs campaigns, the smarter it gets. That's how you build a moat that deepens with use. And now the bear case. Valuation is no longer cheap. The stock has already ran 287%. Revenue is still concentrated in mobile, sensitive to policy changes and App Store rules. The platform is a black box. If advertisers lose trust, spend could shift fast. And they're exiting gaming, which removes some vertical integration. And competitors like The Trade Desk offer more control, which may appeal to sophisticated brands. That's the tension. One side sees runaway risk. The other sees a system that's finally showing what it can do at scale. But here's the difference. Applovin isn't competing on design. It's competing on results. Advertisers don't care how the dashboard looks. They care what happens to their spend. And right now, Applovin is delivering more return than Meta's ad engine. That's the kind of edge that gets stronger over time. So here's my final take. Applovin has product market fit. It has margin, it has a compounding engine. It's not a hot trade. It's a data-driven flywheel disguised as an ad platform. And the market is still learning how powerful that really is. Here's what the data says. Not the headlines, not the hype. The data. And every number you're about to see comes from Market Chameleon. If you want to pull this yourself, I've got a free 7-day trial link below. Applovin reports earnings November 5th after the close. So what usually happens? For the last 12 quarters, the average move 3 days after earnings is up 8.4%. That means it doesn't just pop during the call, it drifts upward after the event. And that's the window most investors ignore. But here's where it gets stronger. Post-earnings drift averages up 12.3% with 92% of outcomes positive. That's not a coin flip, that's an edge. Now, let's talk about the setup. We're 7 days out from the announcement, and look at this. Selling the 25 Delta put 1 week before earnings has been profitable 100% of the time for the last 12 quarters. Same timing, same contract, every time it printed cash. That's not luck, that's data. This is how you approach trades with conviction, not based on feelings, but on repeatable outcomes. And only Market Chameleon makes this kind of historical analysis accessible to everyone. It's not flashy, it's not gamified, it's built for investors who treat this like a real business. You want the edge? It's already built. You just have to stop investing blind. So is the applovin business getting stronger every quarter? Yes. Are the numbers trending up across revenue, margin, and cash flow? Yes. Is the product becoming harder to compete with? Absolutely. That's what you bet on. Not headlines, not noise, systems. And based on the last 12 quarters, the data points to another strong earnings setup. No guarantees. This is still earnings, and anything can happen. Let me show you a cool trade idea. Inside Market Chameleon, I like to filter using the top 3 by win rate. Right now, there's a bull put credit spread showing a 99% historical win rate heading into earnings. If you want to learn options, this is what you focus on: high probability, high efficiency setups. And here's where it gets better. Market Chameleon has some of the best screeners I've ever used. This is my custom naked put screener, and it's built to find setups where I either keep the premium or get the stock at a discount. Here's an example. HUT is showing a 94.9% historical win rate on the October 31st $38 strike. If I'm bullish, which I am, that's a setup I'll take all day. That's how you stop guessing and start building probability into every move. Applovin isn't a trade, it's a system. They rebuilt the engine. They're ditching the low-margin gaming segments. They've got a performance-based revenue, a high ROI AI engine, and margins that are spiking quarter after quarter. My thesis is bullish. The risk is there, no question, but the reward is scaling, and the engine is compounding. That's why I'm looking to buy the stock and plan on selling a cash-secured put today. This is my real portfolio. I'm up 76.7% year to date. That's not luck. That's the result of running a system. You can try to figure it out alone, or you can plug into my system and a group of people already getting results. Master 4J was making 2.5% a month before joining. Now he's collecting premiums, stacking wins, and pulling investments with confidence. Not because he's guessing better, because he's operating with a system. And here's a $5,200 gain on a single trade. Steven didn't YOLO into something random. He used the same tools, same framework, same system that I use and teach. This isn't about being perfect. It's about getting better results and repeating what works. Inside my Patreon, you get real-time trade alerts with full breakdowns, entries, exits, and the why behind every move. Daily market analysis, no fluff, just what matters. The exact momentum strategy I use to scale 7-figure positions with discipline, and access to the most execution-focused community of investors I've ever seen. It's only $30 a month, and that's nothing when you see what it's doing for others. Instead of blowing $30 on bullshit, put $30 into something that could actually make you better. And if you don't 3x your investment in yourself, cancel it. Simple as that. You can scroll or you can scale, but don't say you weren't told.